the Indian market. The Nifty slips below 17,700, holds around those levels after recovering a little from the lows. Energy, banks and consumer durables sell off. The pharmaceutical and FMCG stocks gain. The broader markets, however, corrects in line with benchmarks. Adani Group stocks continue to correct on research firm Hindenburg's report projecting an 85% downside in the group stocks. Tata Motors reports a strong third quarter led by strong cash flows from the Jaguar Land Rover business. The company posts its first quarterly profit in 2 years. Bajaj Auto posts a strong quarter despite weakness in exports. EBITDA comes in at record highs, while margins also grow for the second quarter running. Brokerages remain bullish on the stock. Dixon Technologies' third quarter numbers disappoint. Earnings miss estimates as mobile business slows down. The management also cuts guidance for FY24 as global mobile shipments slow down. Amara Raja, on the other hand, is trading with gains after a very strong set of third quarter numbers.
Hello and welcome to Chartbusters. I'm National D'Souza and joining me as always is Mangalam Malu. Well, we are bracing for a rather tough session for the bulls. In the first hour itself, well, we are down close to around 200 points on the Nifty. The Nifty Bank is down 1,000 points. Remember, it's following up a 1,000-point decline with another 1,000 points. Now, that's the worrying aspect. It's the highest weightage on the index, and that one, in fact, is taking a hard knock. But a couple of these heavyweight stocks, if they can put their hand up and get counted, it's going to be rather important. HDFC, case in point, that's down close to around 3%. Let's see whether or not we can see some buying on either of this HDFC, the HDFC Twins or ICICI Bank, because one of the big boys will have to put their hand and get counted. The auto stocks are doing well. The problem is they don't account for much on the index itself. So Mangalam, rather weak looking screen, but the hope is that we see a bit of a bounce for the time being. Last hour, 90 minutes or so, any kind of bounce is getting sold into by twice the amount of velocity.
There is a fair amount of, worry as far as any recoveries are concerned. It is falling vociferously.
Yeah.
But, what's also not looking good is the way the mid-cap end of things is looking. At an index level, you would say, okay, the mid-cap index is down 1.3%, which is pretty much in line with the other frontline indices. But the broader markets, you have 2,300 stocks in the first hour of trade itself, declining for just about 466, which are advancing. So 5 stocks in the red for just one, which is attempting to hold on into the green. And more than that, it's the quantum of declines, which is much more than, the number of stocks which are declining. The ones which are gaining are about 2, 3, 4 odd %. But look at the ones which are falling. And I'm not even talking about the Adani Group stocks which are falling, but some mid-cap names, Dixon Tech, a wee bit of a miss on the numbers, a guidance cut. And after having corrected 30% on the top, the stock is down, almost 16% now as we speak. Indus Towers is the other one, down 12%. And then we have a bunch of other names as well. Teamly is down around 9%, IG Petrochemical down 6-7%. So the quantum of decliners much higher, and even as the number of decliners are high as well. We are seeing weakness in the market, so let's see where we go from here. In the frontline space, we do have some weakness coming in from, the banking names, but the only one that really stands out on the way up is Bajaj Auto, and we've seen a 7% move on that one, along with Tata Motors, of course, both of them reporting good numbers. But I believe we do have with us the management of Indian Bank. Talking about Indian Bank itself, it saw its net interest margin improve for the third straight quarter this time around, and higher net interest income as well as lower taxes also aided their third quarter performance. The bank also saw credit costs rise on a sequential basis. The stock is lower right now, so it'll be important to know what the management has to guide for going forward on credit costs itself and loan growth. We do have with us the MD and CEO of Indian Bank, Shantilal Jain, joining in to tell us more about the numbers. Thanks a lot, Mr. Jain, for joining in. And that really is the first question. You had earlier targeted about 10 to 14% sort of loan growth. What's the outlook there? Do you maintain that? And on credit cost itself, I mean, what's the sense that you have? What kind of number can you guide for?
Yeah, good morning. Good morning. So our credit growth was 13% is against the guidance of 10 to 14%. Under the credit, in all segments of the credit are growing on the equal space. Retail is growing 15%. Agriculture is growing 15%. MSME is growing 6% and the corporate 7%. As far as credit cost is concerned, the credit cost has come down significantly in the last quarter. And you see our gross NPA, net NPA number has come down. The net NPA has come down to 1%. So going forward, credit cost will be declined substantially.
Okay. All right. Mr. Jain, give us a couple of numbers first. As you said, I think you're growing by around 13% approximately. That's within your margin, your guided band of around 10 to around 14%. For the year ahead, that's FY24, what kind of a loan growth you're looking at? And the point we get on your credit cost, that it's come down over the last few quarters. But on a sequential basis, it's moved up a little bit higher. So given that you're guiding for this number coming down further, what is the number you're looking at in terms of credit cost? Go ahead, sir.
You see our performance for the last 3-4 quarters. Every quarter we are growing between 12 to 14%. So we'll continue to grow at that space.
Okay.
First point. Second point, you see we are a retail bank. 62% of our book is a RAM portfolio where all the component of retail, whether it is a housing loan, whether it is a education loan, whether it is a auto loan, whether it is a jewel loan, all are growing between 12 to 15%. So we'll continue to grow at that speed. Regarding the credit cost, what happens in this time the credit cost has come down, sir. Slightly cost has increased under the restructured standard asset. We have improved some provisions on the restructured asset. That is why it is improving. Otherwise, credit cost has come down significantly, and going forward also, since the net NPA, which was used to be quarter back 1.5, is now 1, and which was a year back around a 2 plus, has come down to 1. So credit cost will definitely go down going
Give
forward.
us the numbers, sir, on credit cost. What will it go down to?
Yeah, it will go down, sir, since my net NPA itself is a 1%. So naturally it will be below 1%. Na?
Okay, credit card will be...
Fourth point, just I want to add, sir.
Go
you see, last 2 quarters, our recovery is more than our slippage. Last quarter, our slippage was 1,300 crore. Recovery was 2,600 crore. Likewise, Q2, our slippage was 2,400. Recovery was 3,200. In a 9 months period, the slippage was 5,400 and recovery is 6,500. And going forward, the SMA number is also coming down. Collection efficiencies, we are maintaining 95. So definitely the credit cost will come down going forward.
All right. So the number that we can take forward from this is the fact that credit cost will be below 1%, even as the net NPA itself is at 1% itself. On gross NPAs, you had guided for about 7%, stands at around 6.5%. So we assume that that number is likely to stay within that range itself, right?
Gross NPA will also come down. The way we are every quarter.
Okay. What will that come down to?
It should come down from the 6.5 level. It should be around 6 to 6.5.
Okay.
Okay. All right. Mr. Jain, given that you're going to grow at, this 12 to 14% odd, do you have any fundraising plans, or do you believe you're, adequately capitalized?
As far as our capital adequacy is, we are 15.74%. And if we add a profit of 9 months, it is around a 17%. So it is 150% of the regulatory requirement, first point. In the CET1 also, we are is against the 8%, we are at 160% of the requirement. So capital side, we are adequately capitalized. Our profits are adequate to take care of our credit growth. Even then, we have a board approval for raising 4,000 crores. So as and when the good opportunities will come, we will discuss among the board.
All right. And, I just wanted your thoughts on 2 things. One, your write-offs continue to remain high. Your write-offs this quarter were close to around 1,800 odd crores. Yes, we did see a decline quarter on quarter of about from 2,500 crores to around 1,800 crores. So why is it that the write-offs continue? That's point number 1. And secondly, what kind of NIMs or net interest margins are you targeting going ahead? 3 plus, will that sustain?
Yeah. So you see quarter 1, 3.1, quarter 2, 3.2, quarter 3, 3.74. So going forward, our margins, which we have given the guidance of 3%, now we will be better than 3% in the year as a whole. Presently, we are at 3.35%. So we should be able to protect that kind of a margin in the next quarter to come. As far as write-off is concerned, write-off basically is based on the gross NPA provisioning requirement and all, we take a call because we get a taxation efficiency on that. And you see my provision coverage ratio is at a 93.59%. So most of the accounts are virtually 100% fully provided for.
So you're saying that the NIMs will hold at these levels, right?
Yeah, we should be able to protect that.
Okay, all right. What about the NCLT recoveries in the next 6 to around 12 months? If you could give us a rough number out there.
Yeah, recovery is happening from the NCLT and recoveries from the NARCL will also happen from the NARCL. So we are expecting that 1,000 crore plus of a recovery will be come from the NCLTs in a year to come, not in a quarter.
Okay.
Quarter maybe 300, 400 crore or so.
Okay, so 1,000 crores coming in from the NCLT accounts, 300, 400 crores would be on a quarterly run rate. A total recovery would be close to around 1,000 crores from the NCLT bit itself.
And yeah, we have given a recovery target of 8,000 crore for a year. Is against 8,000 crore. We are at 6,500 crore in 9 months. So in a 9 months, our achievement is 108%. And on average, we are recovering around 2,000 crore. So we will be able to recover 2,000 crore in the next quarter as well.
Just two things I wanted to know. You said your corporate and MSME loan growth is around 6 to 7% against your overall loan growth of 14%. Is that deliberate? Are you looking to increase your corporate offtake of loans? And secondly, there is talk of PSU consolidation, mergers, acquisitions, etc. Do you think that is likely with your bank?
In a corporate, we will continue to remain selective and choosy. Wherever we are having a good margin, we are taking an exposure in corporates. That is why it is 6 or 7%. And in the retail, we are getting a good margin, so we are aggressive on that front.
And any restructuring? Are you looking to merge with any other companies, etc.? PSUs? Is there any word?
Not yet. No plan yet.
Okay. Thanks a lot, Mr. Jain, for giving us all those details. Targeting NIMs upwards of 3.5%, 14% loan growth will continue, asset quality will improve, credit costs sub 1%. That's the management of Indian Bank. We take a short break, come back, we stay tuned as we discuss market technicals with Sachidanand Uttekar after this short break. Welcome back. There's some recovery that we're seeing from the lows, almost 60, 65 points on the Nifty, and that can be attributed to a couple of names. We do have some recovery coming in, the HDFC Twins, HDFC Bank as well as HDFC Limited, though both of them are still lower in trade. And at the same time, the auto stocks continue to do well. Bharti Airtel too has recovered from the lows, still hovering around just that flat line itself. All of this while FMCG continues to power ahead. We have HUL, which has moved to the high point of trade. So good time to get in Sachidanand Uttekar for a quick check on the market. Sachi, it's been a rough 2 sessions. Where do you think we go from here? Will today's low be an important mark to watch out for, or every bounce is likely to be sold into all the way up to maybe the 200-day moving average?
Good morning, Mangalam. Mangalam, I think if you look at the overall structure, the structure is still weak. And I think every bounce back would be a good opportunity to add on to your shorts unless we don't swing back towards that 17,550 kind of a zone where its 200-day exponential moving average is placed. Yes, in the last 2 trading sessions, the fall has been vertical, and that's why I think we have seen this intra-day's recovery from the day's low. But going forward, we don't see that particular low getting sustained. So any opportunity on the higher side towards 17,770, 17,800 would be a good level wherein fresh shorts should be considered. The stop loss from here on clearly stands at 17,780 on 880 on a closing basis. And unless we don't see a firm reversal getting shaped up on the lower side, the trajectory remains on sell on rise for a target of around 17,550. When it comes to Bank Nifty, the structure is very similar. We are seeing some support somewhere close to 40,300 kind of a zone. And even right now, the way it breached below that 41,000 mark, in case if we get an opportunity on a pullback, we would be using that particular opportunity to create fresh shorts there. So 41,230 is a significant level. Unless we don't see a closing established above that, we are not expecting any firm reversal. So both the indices are still in that sell-on rise mode.
Okay, all right, got that, Sachi. What about individual stocks? Do you have some ideas for us?
Good morning, Nigel. Nigel, I think IRCTC is one particular counter which has been on the weaker side. If you look at the last 4 weeks, we saw a rising 3 kind of formation. The stock was struggling to maintain its highs around 640 zone, and today again we have seen a fresh breakdown there. So we expect this particular move to continue towards 590, 575 zone. These are the positional targets for this particular trade. The stop loss should be placed at 625. And the second pick on the short side is Hero MotoCorp. If you look at the last expiry, the stock was struggling to sustain above that 2800 mark. We saw some momentum getting generated in today's session, but again, we have seen fresh shorts getting piled up near to that resistance zone. So we are expecting, further downtake in this particular counter. An immediate move towards 2680 could be expected. Fresh shorts should be considered in Hiromoto Corp. The stop loss should be placed at 2820.
All right, Sachi, thanks a lot for joining in and giving us your views. Negative and suggest shorts until we cross that 17,780 mark on the Nifty formidably. With that, we focus on a special segment where we get you ideas for profit coming in from our colleagues at Money Control Pro. Anubhav Sahu joins in.
Thanks. We recently reviewed the results of our preferred play in CRAM space, that is Syngene. Syngene posted a strong underlying growth of 28%. Growth was primarily aided by steady performance in the discovery services, which is their research division, and a strong performance in the biologics manufacturing. Now, Q3 EBITDA margin has, however, contracted due to changes in product mix and higher other expenses. Revenue mix has a higher contribution of manufacturing, which is currently at lower margins due to lower level of capacity utilization. Having said that, our EBITDA margin is expected to improve from second half of fiscal year 24 as operating leverage kicks in. It is in this context, major development is regulatory approvals for the biologics facility in Bangalore for commercial supplies. Bulk of the biologic capacity audited would be used for the contract with Zoetis to supply drug substance. Another growth lever to watch in manufacturing is that of Mangalore API facility. Here the US FDA approval is expected in second half of fiscal year 24. So overall, we are positive on the underlying revenue growth. We're in expansion in the collaboration with the likes of BMS, Baxter, Amgen and Zoetis in recent quarters as to revenue visibility. While valuations are pricey compared to peers in CRAM space, strong cash flow and order book visibility suggests that the premium is likely to sustain, and hence we remain constructive on the stock.
Okay, all right. Anubhav, thanks so much for that. For the time being, though, we'll slip into a short break. But as we do that, it's time for our CNBC-TV18 budget quiz. Remember, there are prizes to be won every single day. We give you a question at around 9:14 a.m. And in case you missed it, well, here's the question. Back up for you on the screen. Well, this finance minister asked SEBI in the budget speech to raise the minimum public shareholding in companies to 35% from around 25%. And your options are Mr. Arun Jaitley, Mr. Piyush Goyal, Ms. Nirmala Sitharaman, and Mr. Pranab Mukherjee. Send in your answers on Twitter. Post your answer as a comment on the question tweet on CNBC-TV18 News. Use the hashtag budget with CNBC-TV18. Now hurry and send us your answers. Remember, we'll announce the winner at around 3 p.m. today. Welcome back. Well, Dixon Technologies, that's one of the top losers of the day after a big miss in the third quarter numbers. Well, remember, they'd earlier guided for revenues of close to around 15,000 crores. In the past quarter, it scaled back to around 14,000 crores. But now the management has also cut their guidance to around 12,500 crores. Sonal joins us to run us through what the brokerages are making of the stock. Sonal?
Well, yes, a big downside is what the brokerages are seeing on the stock right now. Let me start with Credit Suisse, where they have downgraded the stock to a neutral, cut the target price as well to 3,300 rupees versus 4,500 rupees per share earlier. Disappointing results, of course. Valuations, according to Credit Suisse, leave limited upside. They reported very disappointing results. And as you pointed out, in December itself, they had scaled down their guidance. And they have cut this guidance further in the interview today as well. So the weakness in Motorola business with mobile revenues sequentially contracting to around 900 crore rupees from 1,600 crore rupees on a quarter-on-quarter basis. Similar decline was seen in the LED TV business as well, where it declined to around 860 crore rupees. Weak consumer demand, lower prices of pass-through inputs led to this revenue miss, according to Credit Suisse. Jefferies says they have a buy rating with a target price of 4,840 rupees per share. Muted offtake in the LED TV business, lighting and mobiles business led to sales miss this time around. They have cut their guidance as well, something that they mentioned to us as well. They pencil in lower sales as well now, 18,700 crore rupees. They are building offtake, lower offtake amid global slowdown in mobiles as well. They have considered lower margins as well at around 4.2% versus 4.6% in Q3. FY23, FY24 capex by the company has been raised, and that's why they have gone ahead and cut their EPS estimates by 11 to 13% for next two financial years. If management's FY24 mobile outlook of 8,000 crore rupees is met, there is a 9 to 10% potential upside to their EPS estimates as well. And lastly, IIFL on Dixon, they have a reduced rating with a target price of 3,335 rupees per share. They've cut the EPS estimates for FY23, FY24 and FY25 by 6 to 16%. And this is, of course, after yet another disappointing quarter. So all in all, there has been cuts across the board and weak guidance and weak commentary from the management about lower demand and exports also being very challenging is something that we are seeing in the stock price reaction as well.
All right, Sonal, thanks a lot for that. In fact, on that note, what we'll do is we'll wrap up on this edition of Chartbusters with the news that there is still a 200-point decline on the frontline indices. Trading hour takes the market action forward.